Hello, welcome to this week's episode of Closed by Mo. My name is Mohammed. I'm hopefully your favorite YouTube host on most things real estate. I'm also a real estate investor and a broker based out of New York City. And in this week's video, we're going to talk a little bit more about the different types of owner financing. I know owner financing is one of those topics that I feel like a lot of new investors will sort of hear about online, on the forums, and all these different real estate podcasts. And you might be thinking, oh, maybe I could buy a house with $0. It's not always the case, and there's actually different categories of owner financing. Now, I will have to sort of disclose in New York City and Long Island and the surrounding areas, owner financing isn't super common, especially in the residential space. I have had it happen a couple of times in the commercial space in either transactions I've been working on or transactions that my buddies have been working on. So it is definitely more common in the commercial space, mainly because it's just more deregulated, right? Owner financing in the commercial space is definitely something that is up to both parties. However, in the residential space, it's something that, since we're getting involved with like residential mortgages that are sometimes regulated by the federal government, you have to be a little bit more thorough in terms of how that deal is structured. Without further ado, let's jump right into the different types of owner financing. Now, to start us off with, probably the most common type of owner financing, which is the same thing that I think a lot of people think about when they think of owner financing, is called a full purchase money mortgage. A full purchase money mortgage is basically when the property owner acts like the bank to the property buyer itself. Meaning, let's say if the buyer is having trouble getting a conventional mortgage, credit score, down payment, whatever it is, and the seller wants to make a deal with the buyer, what they'll say is, hey, look, you're having trouble getting financing, I will be your bank for a set number of years, and I'll lower my credit requirement, debt to income, whatever it is, just to make it more flexible for the buyer. And of course, the buyer and the seller at that point will figure out the terms of that purchase money mortgage, basically, to figure out whether there should be some kind of a balloon payment down the line or any kind of option for the buyer to be able to refinance out of that and get a traditional mortgage whenever the time comes, and as well as for the seller to get their money down the line too. The second type of owner financing is what we call a contract for a deed or a land contract. Basically, in a land contract, the buyer would get equitable rights but not legal title to the property itself. So basically, the buyer would own the property. However, depending on how the contract is set up with the property owner or the seller itself, the legal title will still remain with the original property owner up until that contract has been completely satisfied. So in this particular case, the owner might say, hey, I'll do a land contract for you, Mr. or Mrs. Buyer. You'll make a certain number of payments up until this date, or you have to meet these specific qualifications, or you have to, get some kind of monetary goal in place. And at that point, the seller will transfer legal title over to the owner, or sorry, the buyer at that point. So again, the buyer has equitable claim to the property, but not legal claim to the property itself. The third, which is also a little bit similar to the land contract, is called a lease option or a lease purchase. This is very. I mean, this is also sometimes called the master lease, especially in the commercial real estate world. Basically, the buyer or the renter or the leasee is leasing the property from the homeowner themselves or the property owner themselves, and the owner and the buyer will figure out any kind of a structure that would make most sense for them, whether or not the lease payment is, a portion of it is going towards like the overall principal balance, or there's any kind of like special rule in place that gives that property or the leasee the right of first refusal or the right of first purchase on a set strike price or on a set predetermined price to eventually buy that property from the original owner when that lease expires, or whenever the buyer or the leasee in this case is ready to do so. The fourth kind of owner financing is what we call a wraparound mortgage. Now, wraparound mortgage is kind of really similar to like a full purchase money mortgage. It's also kind of similar to subject to financing with a little bit of a twist. In a wraparound mortgage, let's say the property owner already has a mortgage on the property, but the buyer wants to buy it, of course. So what the seller will do in that case is instead of the buyer getting like a traditional mortgage, the buyer would basically go to the seller, who would become the bank. They would get a mortgage or like an owner financing from the seller themselves, all while the seller still has their original mortgage on the property itself. So in this case, the buyer is paying the seller for their end of the mortgage, so whatever amount that is, and then the seller is then making the payment to that existing mortgage seller. So the buyer has not taken over the seller's existing mortgage or anything, and anything like that. Most of the time, this is done when like the original mortgage note that the owner has held has some some very favorable terms or anything like that. And of course, in due time, the seller would eventually pay off the entire mortgage balance, and then the buyer would own the house free and clear. Now, subject to financing is also something I've spoken about before in my social media as well as on my blogs as well. Subject to financing is basically when the buyer takes over the existing mortgage of the seller themselves. Now, the property title in subject to financing will transfer over to the buyer's name, unlike in, let's say, a contract for like a land contract or like a master lease or a lease option. So in this case, the legal claim to the property has been transferred over to the buyer. However, the buyer is now having to either make payments directly to the seller, who then will have to pay the mortgage, because the mortgage is still under the seller's name. This is what we call subject to or sub to financing. And of course, I made a couple of videos about this and how it might eventually trigger like a due on sale clause, which may or may not happen. And there, of course, there's some kind of workarounds for that as well. The final kind of owner financing structure that we've seen is called balloon payment financing. In balloon payment financing, it's sort of a little bit of a mixture of all the different owner type of financing. In this particular case, the owner and the seller will have a structure in place where the buyer would make certain payments to the seller directly, to whoever's financing that note. And then what they'll do is they'll get creative in how they structure that payment overall. So maybe it's like interest only payments for a while. Maybe it's like a big portion of it goes towards the principal, whatever it is. In that particular case, the balloon payment would effectively mean that after a set number of years, usually 5 years, 10 years, whatever it is, there's a balloon payment that the buyer would be responsible for. And the entire sort of the notion behind this is that, hey, before that balloon payment comes due, the original buyer would have had enough time to secure a traditional mortgage from a bank that they would not have gotten beforehand when they initially purchased the property or got owner financing from the seller. So this would give the buyer enough time to be able to secure their traditional financing in hopes to either refinance or technically buy out the property from the seller or the owner financing note itself. This way, the buyer now has their own mortgage on the property from a bank. They own the legal title, an equitable title or equitable claim as well, and the seller gets their money and they're happy with it. I hope you guys enjoyed these different types of owner financing. I know I had a lot of fun making it. I have a blog post about this too, which I'll post in the link in the description below. I hope you guys have fun reading it too. If there's any specific topics that you'd like for me to cover, definitely let me know in the comments below. I'll see you guys next week.